So today we are discussing about cost of capital. So what exactly is the cost of capital? It is the minimum required rate of return or the discount rate which is expected by investors, which is expected by investor. So let's suppose you have invested some amount in a project and that project will lead 12% return to you. And if your cost of capital means from where you have taken the money, you have to pay a cost for acquiring that capital. So if your cost of capital is 10%, means you have taken a capital at the rate of 10% and you have invested that amount in a project which gives you 12% return. It means your project is acceptable. So what is the meaning here of minimum required rate of return is that minimum you have to earn 10% while investing in that project. So I suppose you are clear with the meaning of cost of capital. It is the minimum required rate of return for any project, for any investment which is expected by the investor. So now coming to how many types of cost are there. So first type of cost is historical cost and future cost. So historical cost is that cost which has already been occurred, which is in your balance sheet, that is called as historical cost. Future cost is that cost which one expect from historical cost. What can be the expected cost for future of the same product? Second cost is specific and composite cost. So, specific cost is the cost of a particular source of finance. So, when we talk about specific cost, so there are so many sources of finance. One source is debenture, second is preference shares, third is equity shares. So the cost of debentures or cost of preference shares or cost of equity share or cost of retained earnings, this is called as specific cost. Calculating the cost of any one source of finance is specific cost, and whenever you calculate the cost of all sources of finance, it is called as composite cost, or it is also known as weighted average cost of capital. So calculating one source cost is specific cost, and calculating from all the sources, that is called as composite cost, and this cost is also known as weighted average cost of capital. Next is average and marginal cost. Average cost is the average cost which is there for the production of number of units. So it is calculated by total cost divided by number of units. And marginal cost is the cost of producing an additional unit, that is marginal cost. Next type of cost is explicit and implicit cost. So explicit cost is that cost which directly occurs, like you have produced some bill. So the cost of that bill is called as explicit cost. That is called as direct cost which occurred in an investment. Implicit cost is that cost which is hidden, which is not directly given. Let's suppose you are the owner of a shop and you are running that shop. So that cost is hidden, that land cost is hidden, have some cost that is called as implicit cost. The last cost is called as shutdown cost and sunk cost. So shutdown cost is that cost which occur to a business while the business is temporarily shutting down, like your strike cost, like your lockout cost. Sunk cost is that cost which is not for temporarily shutdown of the business. It is that when your business is sunk and the whole cost cannot be recovered. It is temporary cost, but it is the cost which cannot be recovered. So till here we have discussed about the cost of capital and the types of cost. So now the next is what is the relevancy? What is the relevancy of cost of capital? So the relevancy of cost of capital is that it helps in capital budgeting decisions and capital structure decisions. So capital budgeting decisions are those decisions, let's suppose you have A, P, C, D, there are 4 projects. So where you want to invest, that depends upon your COC and IRR. Your IRR is your internal rate of return. So when your investment IRR is greater than cost of capital, you would be accepting that project. So this is the relevancy of COC which helps in capital budgeting decisions. Next, coming to capital structure decision. Suppose you have taken loan from SBI, you have taken loan from PNB, so you will prefer the loan either from PNB or from SBI whose COC is or whose interest is minimum. So this is the relevancy of COC to take the capital budgeting decision, to take the capital structure decision. So now founding the base of this COC, when we talk about debentures, the cost of capital is interest. When we talk about preference shares, the cost is preference dividend. When we talk about equity shares, the cost of capital is equity dividend, or you can say dividend. Right? And when we talk about retained earnings cost, as I earlier told you that there are 4 sources: debenture, preference shares, equity shares, retained earning. So for debenture, we calculate interest cost; for preference share, preference dividend; equity share, and equity dividend. And retained earning cost is almost same to equity. And further, we will discuss it later on while computing its formulas. So basically, before proceeding ahead, we will take how will you compute specific cost of all these, but there are some basic things which you must know before proceeding to the next cost of capital computation. So in the next lecture we will take the computation of cost of capital for all these sources. So in this video we will compute the cost of capital for various sources. So the first source is debenture we are taking. In debentures there are 2 types: irredeemable debentures and redeemable debentures. So we have to calculate the cost of irredeemable debentures and redeemable debentures differently. And what is irredeemable debenture? That is not given back by the company. But in redeemable debenture, company will take the debentures after some year. So these are called as redeemable debentures. So in redeemable debentures, we have to calculate always the after tax cost, because in debentures it is before tax cost, and all the costs like of preference shares or equity that are by default after tax. But in debentures, we have to calculate after tax cost. So first we are calculating the cost of irredeemable debentures. So the cost of irredeemable debenture equals to interest upon net proceeds. So that is interest is which is directly given in the question, that how much interest is paid on the debentures. When we talk about the net proceeds, or you can say it as P. P is your issue price, and net proceeds equals to issue price. Issue price minus discount plus premium minus flotation cost. So what is net proceed? Net proceed is basically the issue price, and sometimes your debentures are issued at discount, so the discount is deducted. Sometimes it is issued at premium, so premium will be added. It never happens that both are applicable. It is issued at discount and issued at premium. It is not always that the both will happen. Either discount will be there or the premium will be there. So what is flotation cost? Flotation cost is also known as the cost of issue. Let's suppose whatever the brokerage cost or whatever the cost which are incurred for issuing that debenture, that is called as cost of issue. That cost of issue is always calculated on the issue price if it is given in percentage. So issue price is generally it is at par. So if it is issued at par, it is issue price. If discount, so minus discount. If premium, add premium. And flotation cost is always calculated on your issue price, that is at your par value if it is given in percentage. Now coming to the next one, that is cost of redeemable debentures. So the cost of redeemable debenture, it is always before tax cost. Before tax cost of debenture. So before tax cost of debenture,